Why are some cities in America booming and how can you tell the difference before it's too late? Welcome back to the Ideal Investor Show. Today I'm joined by a repeat guest, Neal Bawa. Neal is known as the mad scientist of the industry because he doesn't guess, he calculates.
We rank more than 50 cities in a presentation. Like Northwest Arkansas was not in our list 5 years ago. Idaho Falls was not in our list 10 years ago. The cities do change.
He's back on the show to show us how you can apply his data-first approach to pick winning locations, the secret between how to track and rank top US market, and how to use the current market reset to double your potential returns within the next 5 years. Make sure to subscribe and ring the bell so you never miss an update. Get ready to stop following the crowd and start following the data. Let's now get right into the interview. And Neal Bawa, welcome to the show. Neal is back.
Well, thanks for having me back on the show. I'm very excited to be back. What an interesting time to have this conversation.
Yeah, so thanks for being back. And maybe instead of telling us your backstory, which you did last time, tell us a little bit what has changed. What are you up to these days? What's exciting?
A lot of different things. I mean, that the multifamily industry where I mostly live, is sort of going through an evolution, right? So the industry sort of peaked in 2022 when money was almost free. You know, people who were new to the industry were raising 20 and $50 million. Today, those same people can't raise $20,000, right? So there's been a change because investor sentiment has fallen with 3 years of, no cash flow and cash calls and things like that. But ironically, today, the prices of multifamily are down from peak between 20 and 30%, depending upon the metro and depending upon the age of the property. And so oddly enough, it actually is a pretty good time to buy. But it's only a good time to buy if you believe this thesis, right? So I've been sort of looking at this thesis and trying to see if I can make holes in my own thesis. And here it is, and maybe you can put some holes in it. Here's what's happening. From a demand perspective, demand's been actually pretty decent. In the last 6 months, maybe not so much, but in 2024, we had a huge amount of supply that came into the marketplace, massive number of brand new units that came in. But the market pretty much absorbed all of those units. Now, it absorbed them with some, heavy concessions, but no rent drops. The rent didn't go up. Nationwide didn't go down either. But then in 2025, last year, further supply came in. And when that further supply sort of broke the back of rent growth, and pretty much all of the growth markets in the United States, the Sun Belt, et cetera, West Coast, went into negative rent growth, right? So we're seeing, for last year, nationwide rent growth was flat, but that's because it was positive in markets that didn't have supply. So that's the Rust Belt and the Northeast. But the markets that had supply, the Southeast and the West, had negative rent growth, right? So overall for the year, we were flat. But if you think about it, if you look at the 50-year chart of, where rent growth is every year on a percentage basis and where inflation is, rent growth tends to be above inflation. So 90% of the time, if inflation's at 2%, rent growth's at 3%. If inflation's at 3%, rent growth's at 4%. It tends to be above if you look at a 50-year chart. But last year, inflation was, let's call it 3%. It was a little bit lower than that. So inflation should have been so rent growth should have been at 4%, but it was at 0. So in my mind, we lost 4% rent growth, if you can follow along, right?
Yeah,
so, right, we lost 4% rent growth compared to what a normal year would look like. And as a result, and I believe that rent growth was short term. So that rent loss was short term, meaning we have to make up for it at some point in time, and there's a lot of reasons for that. And it was there because we still had in 2025 a huge amount of incoming supply, especially in growth markets. Now, 2026 is the first year where that supply is really going to moderate, but still the massive majority of 2026 supply is in the first 2 quarters of this year, right? And then the third and the fourth quarter, I don't see a lot of supply. Ooh. I don't know what I did there. I'm not going to do that again. I was really happy. Bottom line is that rent growth basically has been artificially suppressed at this point because of two 2.5 years of consecutive enormous supply coming in, new apartments coming into the marketplace. And as a result of that, anyone who is buying a multifamily property today, I think, is actually buying it at the lowest possible price, because the negative rent growth in all growth markets, assuming you're buying in a growth market, in 2025 means that you're actually paying less for the property than you would have paid a year before, right? And we are 1 year closer to stabilization, so you really should have paid more, but you're paying less because you're always paying on the basis of rent. So if rents are lower, then the price you're going to pay is lower as well. And so I think that a year ago I said to people, this is the lowest price, and I think I was wrong because I didn't anticipate negative rent growth in 2025. I thought it would be flat. I thought it might be like 0.5% positive, because I'm always thinking that even if rent growth is 1%, it's still kind of negative, right? Because of inflation. But I didn't anticipate that there would be negative rent growth in growth markets. So today, the price that you're paying on a per unit basis in a in a growth market, all growth markets, is actually lower than it was a year ago. And this is as close to the bottom that I think it gets. And the reason for that is very, very simple. One, if you've had a year of negative rent growth, then there's a lot of push by all landlords to, start getting some positive rent growth. They need it. They need it to survive. They need it to pay their employees. So there's just a natural inclination to raise rents. But the second, really, the big reason is that most of the supply in most growth market ends in the first half of 2026. Now, when I use the word ends, I'm using it in a slightly frivolous way. Supply never ends. There's always some apartments being built. But there's a wave, a supply wave that ends, right? So think of it as, you're standing next to the water. You always see little waves, then you see a big wave, right? I'm talking about that big wave. It ends in the first half of 2026 in most supply markets. Though I think that there's some that are still not going to be done. For example, Austin, Phoenix. There's a few other markets that have a lot of supply. Dallas also has a lot of supply in the second half of 2026 and even the first half of 2027. But for the US and the vast majority of growth markets, the second half of 2026 should see a remarkable reduction in concessions. Today, a lot of these markets are, for new product, are offering 10 weeks free, 8 weeks free, 6 weeks free. And for existing products are offering, 6 weeks free, 4 weeks free, 2 weeks free, so older product. And those concessions, they can disappear, right? They can just completely go away when when the market stabilizes. Because as a new property hits 80% occupancy, they'll reduce their concessions. Maybe they were at 10 weeks, they'll go to 8. By 85%, they'll go to 6 weeks. At 90%, they'll go to 4 weeks. And at 95%, they'll go to 2 weeks. And then 2 weeks is a pretty stable level. A lot of people offer 2 weeks of concessions. And so I expect to see a dramatic decrease in concessions in the second half of the year in 2026. I don't expect to see a dramatic increase in rents. There may not be any increase in rents. But when you cut concessions so rapidly over a 6-month time frame, your net operating income spikes, even though you haven't raised your rents. Your rents are the same. People are paying the same. But instead of offering them this many weeks off, you're offering them less weeks off. When you do that, your net operating income for a 12-month time frame, it just all of a sudden spikes, right?
Yeah,
Even without a
absolutely.
rent growth.
I think maybe, Neil, at this point, just so that people can follow along, it's important to realize when you look at, let's just say, a 100-unit apartment complex that comes on the market, and I think it's not really that relevant completely if it's brand new, just finished building, or if it exists for 5 years. For the audience to understand, the valuation is not like a house that you and I buy, where you say, okay, this is a 3-bedroom, 2-bath house, and it's in a neighborhood, and all these houses similar finishes, similar size, similar this and similar that. We compare, and then we come to a price. In multifamily, you basically create the price based on the income, meaning like the rent, or like you said, the rent roll. So if you say, okay, it's a brand new thing, and how many incentives do I have to give? Like 10 weeks, that's like 3 months of no rent, basically. You can calculate how much is the actual value of the property, or the actual price for the property that you would have to pay. So I just wanted to clarify this for people. Now, Neil, what I'm kind of, since you said, can we poke something into the theory? One of the things that I'm wondering how you balance what you just described and why you think that we have an opportunity to get into at least the low end, maybe not the lowest and deepest bottom of the market, but at least in a relatively low end,
Lower. Yep.
lower and from an opportunistic perspective. Um, what do you think is, or what is your position about affordability? I'm seeing in my market with my clients, but also just within my network, that a lot of people feel that they haven't been able to increase wages in a meaningful purchasing power kind of way, where over the years, rent has, like you said, kept increasing regardless whether you go like, small scale residential up to 5 units or bigger. So the aspect, how much of my money is actually my income is going into rent, um, seems to me like it has been increasing. So I think this is to some extent also an affordability issue. What's your thought about that?
I don't believe it. And I'll tell you why. Here are the numbers, right? If you are looking at a market in, let's say, California, I live in Silicon Valley. So the sort of the average American that's making 90, $80,000, $90,000 in this area is paying 40% for rent. And the occupancy in the San Francisco Bay Area is still around 94, 95%, extremely similar to the US. Whereas in other markets, people are paying 20%, 21%, 22% of their income in rent. So what I find is that by looking at examples of various markets, some where people are paying 20% of their income as rent, some 25, some 30, 35, and 40, we're finding that all of these markets are at the same occupancy levels,
Okay.
right? Very similar occupancy levels. This tells me that rents are inflexible, meaning as you increase rents, the percentage of people that just simply say, I'm not going to rent anymore is very small. It's there, it's real. So obviously, if you all of a sudden go from 20% of income in rents in, let's say, Chattanooga to 30%, a number of people, the occupancy is going to fall. But as you keep increasing it 20%, 20.5, 21, 22, 23, 24, and you do this over time, it works. Rents are very sticky. So just like oil, and oil is a perfect example. We're recording this while there's an oil war going on. Very, very few people will stop driving or reduce their driving habits if the price of oil all of a sudden goes up by 10 or 20%. We have seen that it takes a 50% increase in oil for a majority of Americans to change driving habits and to, reduce, like not go out or do things like that. 40 to 50% is that threshold. Rent is similar. I think it's got less of a threshold than oil has. But think about it. I mean, fundamentally, the three things that we need to live are food, shelter, and then oil, because oil is a component in food, in shelter, and in everything else that we do, right? So these are the most inflexible things when it comes to where we are. So if affordability was an issue, why is it that people in many markets, dozens of markets in the US, are paying way more in their income than people are paying in these markets? The truth is, anytime, let's say you have two examples. I'll use the San Francisco Bay Area as a market where people are paying 35% of income, and I'll use Idaho Falls as a market where people are paying 20% of income. Anytime you're paying more of your income as in rent, you feel the pain. And the pain is the same. Whether you're going from 34 to 35% in San Francisco or going from 20 to 21 in Idaho
Right,
Falls,
right.
you
Yeah, yeah.
feel the same amount of pain. What I'm trying to point out is there's very little evidence from the last 20 or 30 years that as people go up that ladder, they are going to stop renting. There's very little evidence because there's a real lack of options. I mean, if you're not
Right.
going to rent, what are you going to do, right?
Yeah, I agree with that. I meant it more in the context of you describing new inventory coming into the market. It's, at least in my observation, been getting more and more expensive, meaning like to get inventory finished and then obviously to make the numbers work, from the owner of like a new apartment complex, you
Uh-huh.
kind of forced to have a certain amount of rent coming in. And that's what I meant by affordability, not straight out, is it affordability as percentage of income? But are people able to pay as much rent as needed to make a new inventory actually pencil out, so to speak. You know.
It happens automatically. So this is another one of those things that may not be obvious. So how does the United States create Class C inventory? So remember, Class A, brand new product, or less than 10 years old. Class B might be 10 to 30 years old. Class C might be older than that, right? How do we create Class C inventory? The answer is we don't. Nobody in America has ever built a Class C apartment complex, right? And in the last 20 or 30 years, we haven't built Class B either. We used to, but now it doesn't work. So everyone builds Class A.
Yeah.
So there is an automatic process that happens that if 500,000 Class A apartments are entering the market in a year, which is, last year's numbers was about 550,000, then 500,000 Class A apartments become Bs, and 500,000 Bs become C, typically the ones that are older, right? So there's a gradual move down that happens, and that's what allows for affordability. Because at the end of 2025, there were 500,000 more Class Cs available in the United States than there were at the end of the previous year. So we magically created 500,000 more Class Cs. We magically created 500,000 more Bs by actually creating As. So affordability happens by people building new things that are expensive, which push down the rest of the market. Like today, there are concessions for Class B and Class C that are universal in growth markets. We had not seen that for 15 or 20 years. For 15 or 20 years, if there were concessions, they would usually be tied to brand new buildings,
Right.
because they were leasing up. Today, there are concessions across the board. Everyone is offering concession. Why? Because the market is adjusting for affordability. Those concessions with the Cs are a reduction in rent, right? And they may be short term, but there's also another reduction in rent. Last year, an average American received a 4.1% increase in their income, 4.1, which is a pretty high number, right? And from the beginning of the year to the end of the year, if you look at unemployment rate, 4.4 to 4.3 or 4.3 to 4.4, so it's almost the same number of Americans were employed. Our incomes went up over 4%, but our rents went up 0%, right? So last year, affordability actually increased in the United States, right? Another thing happened. We didn't just pay the same amount in rent. We also had more concessions last year than we had any time in the last 20 years. So that is also actually a reduction in rent. So what we've seen actually is that we've had a little bit of a breather where people are getting a little bit of affordability in the last 2 years because of the incoming supply. And that obviously is not a long-term phenomenon. We know that that's not going to happen. But in the short run, there's definitely some breathing room for Americans. And again, it's super important to understand this. A lot of people love to complain about affordability. But the truth is that rents in the last 2 or 3 years have gone up slower than incomes have gone up. Obviously, we're catching up to the crazy times in 2021 where rents were going up very fast, but also incomes went up very fast in those years because of all the free government money. So keep in mind that there's two parts to this story. And the sexy part of the story is always to talk about affordability, right? The unsexy part is to talk about, well, didn't salaries go up more than rents last year?
Right. Yeah. I mean, I see a couple of different things in that context. Number one, I would say, and I agree with you with the easy government money, but that wasn't really salary. That was more like a handout, right? So
Yes, it was
you
a
can't
one-time handout.
you can't say, okay, I have that every year, so I can move up from B to C or C to B or something like that. Now, the other thing that I see is that people will have the opportunity based on your beautiful description if they started out with, let's say, a 1 or 2 bedroom place, that they could actually say, I can finally get into a 3 bedroom place and start a family, even though I'm still renting an apartment, which they probably couldn't do because it would have just been too expensive at the same quality level, so to speak. Now, what I'm looking at, or what I would love to hear is, you described it really well. You have been in last time we were together and we had the show. Those things that you just described hadn't happened yet. So what does that mean for you, for your business, for your operations?
I think we're still finding it challenging to buy properties because we want to pay less than what other people are paying. And sometimes that can be a foolish thing at the bottom of the market, but we are careful. And so we have not had much luck purchasing properties because there's still a gap between what sellers want to pay, sellers want to charge, and buyers want to pay. But I think in general, there is certainly a opportunity for people who believe that there will continue to be a rental shortage. For the moment, there isn't because of the incoming supply, but that supply is ending. So keep in mind that certain markets, and there's one market in particular, I think that things could get really interesting it's San Antonio, because San Antonio from peak to trough has seen a 90% reduction, 90% reduction in permits, right?
Okay.
So if you look at how many permits San Antonio was pulling in 2022 versus how many it's pulling in 2025, there's a 90% reduction. It doesn't mean anything today. Today, there's plenty of concessions in San Antonio, and the renter is definitely in charge. But 3 years from now, this means that the number of new units that San Antonio will deliver 2.5 years from now or 3 years from now may be one of the lowest in the U.S. when you compare, San Antonio's population and its population growth. So there could be an opportunity there for existing, landlords in San Antonio to aggressively raise rents if they see almost no supply whatsoever.
Yeah, absolutely. And I mean, I honestly have to say, I know and have observed a little bit more about Austin because I'm interested in some of the industries, also from a diversified portfolio perspective. I have some stocks in companies that have a lot of stuff and operations going on in Austin. So I think there is any way for the audience to realize these different markets. It's not just how much inventory is coming in or how many permits are being pulled, but also what's happening in the context, like you said, of population, right? Like there was a time, I don't know if it's still the case right now, but there was a time where there were like 1,000 people a month or so moving into Austin or so. When you have that much influx of new people, I think the builders didn't just go crazy and say, let's build like crazy. They basically calculated that there's a certain amount of new people coming in that will be in need of all this inventory, and maybe they overestimated, I guess probably overestimated. But
I
how
think
is that
so.
for?
But it's natural for new construction to overestimate. That happens all the time. So
Right.
I'm not surprised that they overestimated. But I think the challenge with Austin is that the incoming permits have not fallen by as much as San Antonio. So I use it as an example. Austin, of course, in my mind, is a better quality metro in terms of long-term rental quality and in terms of long-term overall metro quality. And so people know that. So we are continuing to see a lot of permits being pulled in Austin, but certainly way less than they were at peak. I think we're down about 50% in Austin, roughly.
So just, I mean, maybe for me, but also for the audience, are you kind of saying the influx of people into San Antonio is significantly lower? So this kind of quote unquote short-sightedness of not really planning for much more for the next few years could actually lead to a shortage. Is this kind of what I hear?
No, I think that San Antonio market is sort of a little bit shocked with what is happening with concessions and negative rent growth. And so that particular market has pulled back more than other markets have.
Okay.
Um, I don't actually see any significant reduction in population growth and population influx in San Antonio. It's pretty robust. So
Okay.
just different markets have reacted in different ways, and San Antonio is sort of more negative right now, and so we are seeing a big reduction in permits, and none of that is showing up in rent growth. It's still very negative. We're still seeing huge concessions, but it may mean that 2 or 3 years down the line, we see a bigger gap in San Antonio than we do in Austin.
Yeah, I hear you. I mean, I had Joe Techmeyer here on the show. He is one of these drone pilots that lives in San Antonio, but he goes to, Starbase for launches of rockets or to the Tesla factory and so forth and gets permits to fly drones. And he actually said he's seeing it on his drive between San Antonio and Austin that it feels like those two communities are more and more kind of growing together, right? Maybe not
Yes.
quite to like a Dallas Fort Worth level, but it seems like there's some development going on in that direction.
Yeah, I couldn't agree more. I think that that is happening and that will continue to happen. So I expect that in about 10, maybe 15 years, the San Antonio metro will become fully connected, and the cities in the middle, like New Braunfels, San Marcos, Kyle, will continue to spread and there will be just one continuous, it's about 79 miles from Austin to San Antonio. It'll just become one continuous metro. And we've seen that happen in many places on the East Coast. You see Baltimore and Washington, D.C. being
Right. Yeah,
connected that way.
exactly.
Here in the San Francisco Bay Area, almost the entire gap to Sacramento, which is more than 100 miles, is now almost completely covered with only a few miles of gaps in the middle. So it does tend to happen in metros. So I think will happen there as well.
Yeah, I mean, I dating myself a little bit. I used to visit a company for my training in the Air Force in Mountain View, and they literally had orchards at the time. So if you now go there, I mean, basically, if you go from San Jose on the 101 all the way to the Golden Gate, you can't really say that you have separate communities, right? It feels to me nowadays that you're going basically through one or the Bay Area, even Oakland over to San Jose, Fremont, and this becomes all like one thing with a huge lake in the middle. Now, obviously, the audience is always interested. What does this mean for me? We are maybe not 100% focused on multifamily, but we have you called the wizard of multifamily. What would you say to people who probably not individually have the capacity or do this their full-time job to be invested in multifamily straight out, but they want to participate? So what would be your suggestion or how would you recommend for them to go about it?
I would actually suggest that, at different times, the key factor is different. So in 2009, the key factor was which market has fallen the most from the 2005 height to the 2009 or 2010 trough. And
Right.
those markets ended up being the ones that produced the most profit, as long as it's some decent growth. Today, I would say it's the markets that have had the greatest drop as a percentage in multifamily permits. This information used to be not available, but if you know how to use AI and to use, research mode or deep research modes, you should be able to get that information for metros that you're interested in. I would say that's probably the biggest thing. Now, this doesn't mean that you have to buy multifamily. What I'm trying to tell you is that the metros that are so shocked by the wave that they're not building at all would be good for single family rentals too, right? In general, the rental market in those metros would be pretty good. So doesn't matter if you're doing single family or small multifamily or large multifamily. It allows you to find metros that just have sort of retreated from the market a great deal, and that could create an opportunity.
Okay, cool. And then, I mean, when you say we have been struggling to buy, when you actually do this, are you doing this then through a syndication, or how would actually anybody that, let's say tomorrow somebody came and said, Neal, I have this awesome, just about finished deal in San Antonio. Is there any path for investors to join you, or how would that look like?
Absolutely. So we are making offers on buildings that have been completed but not leased up because we
Right.
think this is the right time to buy those buildings. We are making offers on buildings that, have been around for 20, 30 years, but we see that the rents are getting hammered because so much supply has come into that submarket that that building is not the first or second or third choice of renters. And we know that in 12 months that'll change because once those sites are all leased up, their rents are going to go up and their concessions are going to come down. And so all of a sudden, this property will be able to raise its rents by $50 or $100. And when you can raise rents by $50 or $100, it makes an enormous difference to your business plan. So we have
Right.
investors that we are educating about this gap, this opportunity, and people are listening. We just raised roughly $6.5 million for one of our projects from about 40, 50 investors.
And that would be then in the limited partner role, or in which way would they
They would
become?
be LPs, right? So we would be doing a syndication. We have some funds as well, but right now we're doing more syndications than funds.
Okay, very cool. So if I hear you right, at least for what we discussed about Texas, there is some hope in the future for anybody who is already invested in that market. Any other and I'm not asking you to spill the beans or something, but if you have any others where you would say this is maybe something to keep an eye out or get in touch with you, and if so, how?
I think the most powerful market in the US that has a lot of 5-year, 10-year potential is called Northwest Arkansas, or NWA. It's actually
Okay.
drivable from Dallas. You can, it's about a 2.5, 3 hour drive, I think, maybe more, 4 hours. And that market is absolutely phenomenal. I think it's an incredible, incredible market that everyone should look at for a variety of reasons. I'll just give you the brief reasons. Number one is Walmart. Number two, completely separate reason, is the Waltons. Waltons are the richest
Right.
family
Yeah.
in
Yeah.
America. They're getting older. They're in their 60s, 70s, 80s, and 90s, and they've become deeply philanthropic. And instead of spreading their money around in the US, they're basically competing with each other to invest it into Northwest Arkansas. So that area has absolutely incredible growth. If I've been talking about it for 2 years, I've been telling people the story of these projects, and I was deeply happy to see here that in January 2026, Milken Institute, which ranks cities, ranked Northwest Arkansas as its city of the year. Now,
Okay.
it's not one city, it's a cluster of cities. So keep in mind, we're talking about Bentonville and Rogers and Springdale and Fayetteville. So it's a cluster. They're ranking it as a metro.
Yeah.
But it was wonderful to see it at number one. I've been having conversations around it for 2 years. I've already made investments in it last year. Um, Northwest Arkansas is a phenomenal market. Everyone should check it out.
And maybe as a little follow-up, in markets like that, at least in my limited experience, you also have a chance to get into somewhat smaller, not in the sense of like duplex, three, and triplex, but more like instead of like 200 units or 300 units into getting into something that is maybe not as large. Is that true for that area?
It is. There's a lot more inventory of fives, tens, twenties, and fifties than there is of hundreds and 200s.
Yeah, very cool. And I suspected that, but since I have you, I better I better ask. So if people want to get in touch for Northwest Arkansas or maybe other opportunities and join your crew, so to speak, what's the best way?
We believe that information should be free, and we have always tried to become the Wikipedia of real estate, a completely free repository of very useful, easy to understand charts and graphs type of information, something that you can take a look at and understand. And so over the last 10 years, we have had tens of thousands of investors come to our webinars, which are free. We don't have a paid education platform. We don't have like a premium or subscription. It's meant to be free. 1% of those people become investors with us because when we do a webinar, we'll take 60 seconds to talk about an upcoming offer. But otherwise, we don't, typically we don't have a sales staff as such. And everyone that connects with us comes in through multifamilyu.com/club. That's multifamily followed by the letter u.com/club. And you can see our last 24 presentations saved there. Tens of thousands of people have watched these presentations. They find them very useful. We update them all the time. For example, right now I'm updating the impact of Iran war on and the oil shock on real estate and on the economy in general. So that's the next one that we're writing. But we also rank cities. So in January every year, we rank more than 50 cities in a presentation. So it's very fun. It's very interesting. People are always like, what about my city? What about this city? And
Yeah.
and so while we'll rank maybe 50 or 60, we actually answer questions about another 100 or so. So that's a presentation that's always been a favorite. So multifamilyu.com/club. It's always free.
Yeah, thank you, and I appreciate that you educate the public or interested people in that way. If I remember right from last time, didn't you say that you don't always do the same 50, that they're kind of rotating at least to some extent? Isn't that right?
I wouldn't say it's the same 50. They like Northwest Arkansas was not in our list 5 years ago. Idaho Falls was not in our list 10 years ago. So the cities do change, but it's fair to say that certain states tend to be more dominant
Right.
than other states.
Yeah, makes sense. Well, Neal, thank you so much for coming on the show for a second time. It's always super educational, and especially since we are going through so much change. I mean, I could have asked you so many more things. You mentioned the war. I'm thinking AI is going to do some things to all of us in some way. I don't know if, somebody like Elon is right when he says sooner or later we don't need money anymore. I can't really imagine how that works. But thank you for being on the show, and I hope we can do it a third time sometime soon.
Yeah, I'd like that.